played hide and seek for hours, raised our shadows among the pines. So offshore, playful and free, without a care in the world. I was one rich little girl, daydreamer, kidnap me, take me back, all the way back to them days, running around in a gown and a crown, barefoot. No mistake ever kept me late. We spent summers catching fireflies and winters on our skates. One big smile across my face. We used to dance our way to church on Sundays. Mama set the pace. Daydream.
Check 1, 2, check. Look at you. Yellow, hang on. I'm not getting any sound. Try it now.
Can you hear me?
I can hear you.
All right.
How you doing? Wow, that looks really good.
How are you doing?
I am doing good. Got a little construction going on back there, I see.
Yeah, how about my little stencil? It's not all the way in yet.
I love it. I love it. So,
we're a work in progress, Andy.
I understand. So, adjustable rates, I'm just gonna cover a lot of, just kind of like we did last time, I'm just gonna ask questions and you take it away, and I'm gonna pull up a couple of articles in the national, what is it? Hang on. I'm gonna do something here. I'm gonna turn on. Yeah, you're good. But mortgage rate daily news, there's, I'm gonna ask about that a little bit. Anyway, just have a chat, see what happens.
Yeah. Maybe somebody gets on from California.
Maybe. You know what? They watched afterwards, so that, gotta remember, I have to keep that in mind. I sure appreciate this. You doing this with me. This is
Man, I'm glad you invited me.
Yeah, it's just, I have to remember, because everything I'm learning about this is that it is long term. We just gotta make that, just gotta do it every week till people start watching, so.
Yeah, and I mean, like a lot of your stuff hasn't been live, but it's worked great.
It works, yeah, and people get caught up about views and subs and stuff like that, which is, I'd love to have more of that, but it's like the guy that called me the other day. I'm all about getting the calls, so
yeah,
that's where we're at. All right, so let's see. I am preview mode. Good. Let's check out a couple of things here. Okay, good. Everything's working. Good. There you go. I'm talking about some nice music right there.
Yeah.
almost ready. Can you see what I'm changing? Can you see that change, or is it just me you see?
I don't see any change going on right now.
Okay. Because I think you have the option at the bottom of your box. You can see the feed, or you can see the host, I think. Doesn't matter. Ooh, doesn't matter.
Oh yeah, I'm seeing, I guess I'm seeing me.
Is it just you? Okay. All right, but you're in there, and we've got 50 seconds. Here we go. Wow.
Hey, are you gonna size me up some? Or is it, I'm fine if you're fine.
Yeah, it's not letting me do it. Probably. We're almost there. Here we go. Hey everybody, how you doing? Happy Tuesday. It is Tuesday, right, Rodney?
It's Tuesday.
Here we
All
go.
day.
There's Rodney. Look at that. Got some construction going on in the background. I am glad everybody's here. What we're here to talk about today is adjustable rate mortgages. We touched on that a little bit. Excuse me as I'm doing some. There we go. Bear with me here. Whoop, there we go. So we touched on adjustable rate mortgages last week. So Rodney, tell me what's new in the world of mortgage the last of last week, the beginning of this. What's new?
Well, not a whole lot new. The rates are kind of hanging steady. Inventory is still creeping up across the country. I read one article where out of the 50 states, I think the top 30 had price reductions. So, we're looks like inventory is heading back a little bit, which I think is good news, because if you don't have inventory, you're going to have a whole different problem than just, instead of rates, you'll have housing shortages as well. So that's not a good thing.
Yeah, I just released a video last night about the price drops, and there was some confusion about price drops. It's not that the bottom line is when somebody lists a house, if it doesn't get sold right away, they entice buyers by lowering the price. But year over year, the house is going to sell for more than it did last year. So that's not the kind of price drop we're talking about. We're talking about dropping it to entice buyers, and there was a little bit of confusion on that. But the numbers on that are staggering. The percentage of price drops in Denver was 46% of price drop in Denver, and that's like,
Yeah.
that's a pretty busy place out there. So there's a lot of changes going on. Are you seeing any? And I know we don't like to talk about rates too much, but you know what? That's what people talk about. That's the questions they have typically. What do you see? What's happened here in the last few days? Have they gone up, down? You said they're holding steady.
Yeah, they actually went down just a hair over about a week. They tried to went down just a little bit, and then they ticked back up. So it was, it's not the drastic climb that we have been seeing. So it was nice to take a little break from the drastic climb for a week.
From the drama. Well, I mean, you certainly have, as a real estate agent, I've always told anybody that cares to listen, my clientele, I'm not a lender and I don't pretend to be, and that's why I come to you. I depend on you for that information. But they ask really good questions like, are the feds, what they're trying to achieve, are they achieving that? What's your take on that?
Ugh, I don't know. There's a lot going into that. What the feds are trying to do, um, and what they're trying to prevent a recession or to calm it. And that's and they're in a rising rate environment. So I don't know. I don't think it's helping. No, not one bit. I would rather see an open marketplace and it be competitive and our economy doing well. I think our rates would be, you know, a little better. But
Yeah,
we've also come off of a 15-year run or something with the rates just being crazy low. I mean, it's been really good for a long time. So it's this has to happen. I mean, at some time.
right. Well, what would happen? What do you think would happen if the R word actually occurred? If a
Well, I'm not sure we're not already in it, honestly. But for our market here and probably most great markets around the country, I don't think the housing market is going to. I think what will happen is just what's happening now. The interest rates rise, the home prices rise, and it puts some people on the sideline for a minute for them to catch their breath. To get adjusted to these new prices, to get adjusted to what payments are going to be and things like that. Because if you were looking a year ago or 6 months ago and you didn't buy, you're paying significantly higher today, with rates and home prices combined
mm-hmm.
than you were 6 months ago. And
Yeah,
with inflation, with the current inflation, everybody's eggs and everybody's bread and milk and gas is a lot higher now. So when you take, say, a $700,000 home, and now the payment is $1,000 more than it was, 7 months ago or whenever you was looking,
right.
that's a lot of grocery money. That's a lot of money to your budget that you weren't planning on.
Absolutely. And everybody has to take that into account. I'm trying to get your picture right. Sorry about the moving around, everybody. And you can see the comments. You can see the comments, okay?
Yes, let me turn on that there.
So, so here's my next question, and it was something that you said last week, I think. And I'm not trying to, me, I'm not trying to catch you in anything. What I am trying to do is I want to ask questions, and we've got some that people sent to me as well. But this caught my attention because you see a lot of loans during the course of a year. You're going to see a lot of transactions, and you were saying last week how there were more concessions happening in your deals that you were seeing come through, seller concessions.
Yes, um, in more ways than one.
Tell me about that.
Um, in a we haven't seen, typically a seller in the past several months. They don't, they didn't even like you viewing the house, honestly. Um, it was if
You
you
have to
don't
come
put a
see it.
contract in, yeah, you don't even schedule an appointment unless you have a contract in to purchase it, right? That's about the worst one I've seen. But when so now when you see things like, we'll pay closing costs, they're paying title expenses, and that's all that was gone away. They wouldn't even repair nothing on the house, so no
Yeah.
repairs, no inspections, and now you're starting to see some of that come back towards the buyer's favor. You're seeing some inspections. You're seeing when it's customary for them to pay title work in a certain county or area. They're going back to that. And a lot of them are even. I've seen several realtors get creative and put on there that they'll help pay for a rate buy down
Mm-hmm.
on a list. Since they may have not listed at a great price or whatever, it's not selling real fast, so the seller agrees to advertise a rate buy down. If someone comes in and puts a contract on it.
Well, and that's good for anybody that happens to be in the real
That's
estate business, to know that that sellers are responding to that. That's great news for us. So let's talk about something here. So, in a basic sense, because we've got a really good question from Southern California there, what are adjustable rates versus 30-year fixed? And we'll ask that in just a second, or answer that in just a second. So, in a basic sense, looks like Southern California might know, but for anybody else that doesn't, how does an adjustable rate mortgage work?
An adjustable rate mortgage is simply a mortgage that the rate periodically adjusts, right? So the benefit of an ARM is just it's initially cheaper than a fixed rate mortgage. The drawback is that it can go up or down, sometimes substantially, when the initial period ends. And today, it's a good time to talk about ARMs because Fannie Mae and Freddie Mac is getting away from going with the LIBOR ARM as it was the index, and we'll talk about that later. But the index for most ARMs was the LIBOR, the London International Bank, and back, I think 2012, there was a lot of bankers from those, I guess, European banks that were caught changing the rate to affect their bottom line, their investments and things like that. So the basically in the U.S. we're getting away from the LIBOR, and we're transferring to what's called the secured overnight financing rate, or the SOFR rate.
Huh.
And this is still, influenced heavily by the Federal Reserve, right? So this is a U.S. margin.
Mm-hmm.
So it's less susceptible to any kind of fraud or manipulation like the LIBOR is.
Oh.
So if you have one, there are some changes coming to your index, just being transferred to a SOFR. But basically an ARM is just fixed for a period, and that's the first number in the rate. Like if someone asks you about a 7-year ARM or a 7/1 ARM, the first number is how long that rate is fixed for.
Mm-hmm.
And that's determined in years, where it be a 3/1 ARM, 5, 7, or 10. That means it's fixed for 3, 5, 7, or 10. The second number in that, if you're talking about like today's rate would be a 5/6 ARM. It means it's fixed for 5 years, and then it adjusts every 6 months after that. So that's the basis of how an ARM works, or
Okay.
how it's kind of set up.
So then we've got two really good questions that blends right into this. And thank you, Southern California, and Angie. Hi, Angie. Two questions. You can see what Southern California is. What are the adjustable rates versus 30-year fixed mortgages right now?
Right now, the spread is pretty close to 0.5% on a 5, and maybe a little bit less, or somewhere around there on the 7-year as well, the 5-year and 7-year ARM. So it's not a whole lot, but it is a little bit of relief from the, what the rates have done. So it's, you gotta, thing about the ARM is just, you've got to weigh your risk of how long you're going to be in there. And in my opinion, there are certain people probably should not have an ARM if you're very, very close and cannot afford any upward adjustments.
Okay. Well, I must have gone to sleep.
But in my opinion, right.
I must have gone to sleep. I missed something. What are the rates versus one versus the other? Did I miss that? Oops.
It's about 0.5% between a 5-year ARM and a 30-year fixed right now.
Got it. Okay, 0.5%. Okay. And then so I think you probably answered the question of Angie's. What's the timeline usually on an ARM going up? Because that is just what you were talking about.
Right. So if it just determines which one you're kind of choosing on the front end, whether it's a 5-year ARM, 7-year, or 10-year, and then it adjusts. That's the fixed period. You remember the first number is your fixed period.
Right.
On a 5-year ARM, it's fixed 5 years, and then it adjusts every 6 months, starting with that after the 5-year mark.
I get it. Well, I'm going to keep rolling with this, with Angie's question, so everybody can see it. So the rates actually stay the same for quite some time. Do you have to pay fees to change to a fixed rate when they come down?
You would, yes. You would basically have to refinance to go to a fixed rate at this time. You would still be paying. The good thing about the ARMs of today is that it's difficult to find a bad one. Okay, due to the Dodd-Frank changes and the mortgage meltdown in 2008 or the housing meltdown in 08.
Mm-hmm.
Dodd-Frank come out and made a lot of changes for the government, restricting prepayment penalties, crazy ARM adjustments, not disclosing it to the customer very well, a lot of stuff like that. So the adjustment period now is just every 6 months, and it's fixed. You're going to have a cap on it. You'll have your index, which will be the SOFR rate. And then your margin, you just add the margin to your index, and that's what the new rate would be. As long as it didn't, you also have caps on those things, Andy. So when the first time it can adjust, let's say it can only adjust 2%. So if you're at 3% and you can only go up 2 on your first adjustment, it can only go 5% total. And then subsequent adjustments every 6 months, they can go up 2%. But you have a lifetime adjustment of usually 5% over the initial rate. So 5% sounds like a lot, and it is, but ARMs are not meant to adjust out over and over again. In my opinion, ARMs are meant for a temporary conduit between the time you get your house and whether you could either refinance it or potentially even pay it off.
Got it. And so is there a particular, I'm reading Southern California there, is there a particular rate today, or is that just going to be dependent, of course, probably on the buyer, the credit and all of that?
Yeah, rates are determined. I'll just pull up one.
Okay.
I can pull up a rate here, and with perfect credit, 20% down, those kind of things. Let me pull one up here. It takes me just a second to get to it. Let's see here.
Well, if you can't find it, that's all right.
Well, that one today would be 5. Who knows what? Just basically what I put in. Today's would be 5.25. And let me tell you what the 30-year fix would be. Let's see here. This one's what's a pretty good spread today? It's 5.875. So it'd be a difference of a quarter to 0.625 difference. So pretty good difference today. Just over 0.5% today.
Right. And so Southern California, does that answer your question? That's what we're trying to do here, is answer your question. So are you seeing, let's ask a different question until something comes along. What, I was reading today that pending home sales rose for the first time like in 6 months. This is really good news, isn't it?
Yeah. Anytime we have more inventory, it's going to be good for our market right now. Sellers have taken advantage of the market, which they should, just due to the demand. But yeah, you need some inventory, or else the demand is just going to be a little out of control, like it has been in our area and a lot of other areas.
Do you see mortgage rates holding some sellers? I want to use the word hostage. It's a little bit aggressive, but do you see mortgage rates keeping some people from selling because they feel like they can't afford to go to the next place?
Yeah, I'm sure. Yes, it's going to take all of America to get kind of used to, rates in the high fives and sixes versus where they've been in the low low to mid twos.
Right.
There is definitely an adjustment period.
Right. I mean, everybody's going to make their own logical reason for moving. In the video,
it's hard to justify it. I mean, like I said, it's almost between housing prices and like a $700,000 house, that payments went up $1,000. So that's a lot.
Well, it sounds negative, but I mean, we're not talking about negative stuff. What I'm trying to convey here is this is what's actually happening out in the world, and this is the questions people are having, especially buyers. For example, for somebody that qualified for a $517,000 loan at 3%, now the same loan at 6%, they can only afford $400,000. So that they're looking at a whole different category of house, almost, but that sort of thing. So if I was, thinking about selling, I'd have to think long and hard about what I was losing, because it cost you a lot to get into that next place, That's a good question. They both had good questions here, Rodney. Really banging on you. I guess that's what we're here for. And I know you don't have a crystal ball any more than I do. Angie's asking, how high do you expect the rates to go? And Southern California is asking in the near future about the 8%. What's your thoughts on that?
I don't see. I do expect rates to continue to climb. I think that we have seen a slowdown in the how fast they have risen.
Right.
I think they'll continue to creep up a little bit. 8% is high. I've said before, I don't think I'd ever see that kind of range again. But, I think our economy has a lot to do with it too, and our, potentially China and Ukraine and how all those world problems, come out. 8% is high. I don't think I'll see. I don't think so, but this is
this is uncharted territory for sure.
Yeah, I mean it's you could ask anybody and everybody's got an opinion on it, but I think 8's awful high. I think it's starting to level out already.
Right. Well, and it's like you said the other week that despite what seems to be traumatic, everything that's going on, houses are still being listed and they're still being sold. The prices are being dropped to entice buyers. I get that. But things move on. And certainly refi, that's pretty much gone now, right? Is that correct? What about refis?
There's always going to be your refi clients, meaning, unfortunately, divorces are a big cause of
Mm,
refis.
mm,
We have families that are doing that, and for there's a lot of people that may run up debt, and even at 6% on their mortgage, it's sometimes better than what they're paying debt on. So yeah, there is some, but it's extremely low. And it's
mm.
most, for us, it's just our past clients and friends and family that do that. So
Right. Then I did get a question direct into email the other day, and I know this is maybe going off topic, but we're covering a lot of turf. Any word on forbearance? Where is that? I think that's dropped down to almost nothing, hasn't it?
yeah, they've most of the investors, that forbearance is over. That they've either, I think it's gone. I think the government, that period has ended where people have to be making their payments now and things like that. And then whatever, if people missed a year, I've seen some people miss 2 years up of their house payments, and
Right.
those been tacked on the back of mortgages, and it looks really ugly. But a lot of people needed it, but people just that took it that didn't need it, man, they were like, man, I don't know why I did that, Rodney. I should have just paid it, because it just adds up fast when you go a year without making your house payment.
Yeah, I wouldn't, my heart goes out to folks that do that. So, just sort of wrapping up this last couple of minutes. So, it seems to me that adjustable rate mortgages in the recent past was just something not even to be considered because of the way this interest rates were. I mean, nobody was even talking about those. And then as rates jump up, all of a sudden they become a viable option. I mean, that's where we are today, right?
Yeah, the good thing about adjustable rates is, due to that meltdown, we had a lot of good changes to those rates. Um, those rates adjusted really fast, most of the time within 2 years. Um, they also had extremely high margins, uh, extremely high caps, and they never had a chance to go down. Like, if you were to get a rate, if you were to get a arm today, a SOFR arm, and then the rates plummeted, you could ride that arm, for a while. If the SOFR goes down, the index, your margins, all you're paying, which should be about 2.75% on that. So you'd be really doing well if it was a declining market. You could ride that arm out. But the old arms, you couldn't do that. They went up no matter what. So in today's world, it is a risk, but it's a manageable risk when you're trying to fool with an arm. If you're just a little bit, if you're savvy and you're good with your money, you can handle an arm to where it could benefit you by gaining the advantage of the first 5 or 7 years or whatever you have on it. So it's
Right.
it's it's still a good product. You just gotta. It's just not for everyone. Like, if you're tight on your budget and you can't afford a payment to go up at the end of 5 years, then you do not need to do this. But if you're like, hey, I'm going to take the risk, I'm going to make some money for this first 5 years, I'm going to put it away on my principal or whatever you're going to do, then that's a savvy person that can take advantage of an arm.
Right. Well, and I think that that's what today's live stream really is about. That, and you really said it best. If you're a savvy with finance, you'll know what to do with this. You'll have smart conversations about it. But the bottom line is, it is for anybody. It may present an opportunity that wasn't worthwhile not so long ago. I mean, there's a lot of different. We've all got a lot of different options, I think is what I'm trying to say. So,
Yeah, and there's a lot of research that say mortgages don't last but 7 years. So
hmm,
some have put out there that the average is 13 years. I just don't see that. I see my clients rotate about 7 years on average. Uh, but so 7 years. I mean, you think you get a 7-year arm, and it's a 0.5% lower for 7 years. You've got a good deal, and
Yeah,
especially if you know you're gonna get rid of it.
right. Do you, just a final question for you. Um, do you have any sense of how it's like I'm asking you to predict the future. I'm not, but do you have a sense of how things are going to transpire here in the next month or so? Do you have a feel for that?
More of the same. I think that our area right now, and a lot of areas are kind of a little bit slower due to vacations and things like
Mm,
that.
yeah.
Typically, this is vacation season for my area. Early July. So I see more of the same. I see the rates kind of hanging around where they're at, but I see inventory still increasing, um, especially until I think people get more comfortable with with the new rates and payments and sales prices.
And I think that everybody's got to settle in and kind of accept, the inflation is pretty tough right now. And so people have got to settle into kind of the new world financially, you know? I think there's a lot of uncertainty is what I'm getting at. And
Right.
I
Yeah.
don't, none of us likes uncertainty, and it's interesting that sales go down, but pendings go up, and it's a crazy world of real estate right now. It's crazy. But
We're,
listen,
we're,
no, go ahead.
Yeah, we just did a great job market. Nashville. So Nashville and our surrounding counties are so good with employment. Uh, so it is as long as that stays strong, we'll always have a good, healthy sales market. But it'd be as when confidence comes back in people's jobs,
Yes,
and
yes.
inflation starts tapering off, I think our activity will increase more than it is now.
I agree with you too. And to address Angie, she's got a good question. And again, I don't have a crystal ball either, more than anybody does. But I do feel like it's going to level out. And if I'm not mistaken, I think that we both live in areas where, there's some, the Nashville area is strong. It just is. And that's what, Rodney, that's what you've been saying. It doesn't make us insulated, but it does a little bit, to the highs and lows of what's going on. And there's some parts of the country, there's a report on Boise, Idaho, and how they really consider that to be overinflated. I don't know that that's the case. But we can see what's transpiring in the rest of the country that's getting shaky and that sort of thing. So we can kind of see it coming a little bit. And I know that these are both California people, and California's pretty solid, I think,
Yeah, it's like areas of California, areas of every major city. Our Williamson County, Davidson County, we're probably not going to see a pullback in prices, but a more modest increase or leveling off is what we're seeing right now.
Right. Is a correction less than 10%? Is that what a correction is?
I don't know.
What the definition of that?
We're not going. Our correction's going to be it just slows down some. I mean, I think other markets that are not as with just all these tech jobs coming here and all
Yes.
what is that automotive? I mean, it's just crazy how many big companies are moving here. I mean, it's still 100 people a month, so or a week. It's just a lot of people moving into our area that is keeping us from. And then a lot of local people has been sitting on the sideline pinning up because they have lost out on 25 properties.
Yeah. 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 It's crazy. Well, hey, listen, it's been a really good discussion, Rodney. Thanks for your time. Southern California, thank you very much. Angie, as always, so good to see you on there. And I hope this is helpful. And I don't have any idea what we're going to talk about next week, but we'll figure something out. We'll make sure that it's good. Anyway, so thanks everybody, and we'll talk to you next week. Rodney, see you.
All right. See y'all later. Thanks for joining
buddy.
us.
Bye.
See you. Bye.
All right, hang on, man.
I'm here.